Happy Friday, everybody. And brought the quiz and we brought the weather. So those are two unrelated events, but I'm kind of concerned because it's cold outside, but cold is not enough to stop my diehard auditing students. So I appreciate you all being here, but if it's really, really snowy and slick, then may be a problem on Monday. I'll address that when it comes with it, but likely the class actual meeting will be canceled, but the class itself won't be canceled. That's the wonder of online meeting places like Zoom, that you would still have to do the work. So now you may say that's really not fair, Dr. Barnes. I'm going to say, you're paying me to help you with this work, so it's important that we actually meet if possible. So probably what I just have you do is meet via Zoom. But I do want to mention something that will probably result in a class that we won't have to meet. So I've been working on the week 4 assignments, and they are almost updated. I still need to finish the quiz. But for week 4, we're going to be doing something a little bit different. Normally what we do is we have a Monday class session where we meet as groups and we talk amongst ourselves, and then on Wednesday we present the results. And that's going to be consistent through the semester. Even on those days we're not meeting on Monday, we'll have like a Wednesday meeting and then have the results on Friday. Week 4 is a little bit different because if you remember, I mentioned the FBLA competition that I encourage you to participate with if you are available. I've already told Dr. Caden that I'm giving the GTRA students, or GTRA, the graduate students off that day. The expectation is probably the GTRAs will have to help out with that, but graduate students, I encourage you to help out as well because there's some interesting opportunities. That is February 4th, which is a Wednesday, the Wednesday of week 4. On Monday, you're going to need to have an assignment completed and submitted for Monday. And it's actually an ethics and professional conduct assignment. And so I know it's unfair making you do additional homework outside of class. Life is rough. If you're angry at me now, you're probably get a lot more angry when you read the case because the case is just depressing. But yeah, it's one of those ones that talk about the downside of auditing. And we do need to approach topics like this because they are very practical and very relevant. They're not necessarily very pleasant to read. So just make sure that you are aware that for week 4, you need to come in on Monday having completed the assignment. It's not a particularly difficult assignment, but if you don't complete it, I'm probably going to be a little bit miffed since I'm making this announcement in class. All right, let's talk about our CPA prep. Now, I want to start off with the CPA prep goal here of understanding that part of this is going to be a reflection of the concepts, but probably the bigger goal here is knowing how we want to approach these questions. And it's very interesting. I can't really blame this entirely on AI, but I think there's some impact there. When we started doing this back in when I first started teaching seminar auditing, which I guess would have been 2019, I think was the first year that I taught the graduate level, we were doing this and there was a very, very profound impact. And the performance of students just started really increasing. We started focusing on the questions and how to approach these questions. And it kind of culminated probably like in 2022, and then 2023, 24, it's kind of declined. Last year was kind of abysmal. We had a very, very low pass rates on the auditing section. And again, I think that some of that has to do with the lack of research or lack of work that's being done outside. So I've kind of recrafted the way that we're approaching this, and it's extra work for you all. And I apologize for that. I am very, very lazy. All right, so. I'm not a big fan of doing extra work when extra work's not required, but I do think it's necessary because we kind of need to get back to basics. So this is kind of the goal of these particular activities. I've cut some things out that I've done in previous semesters that were more fun for more productive activities in this regard. And hopefully you'll find that important, even if you are not sitting for the CPA exam, or in some situations you've already sat for the audit section. You may find this relevant to other sections as well, how to just generally answer topics and questions. There's also going to be some professional issues. We're going to be talking about relevant topics. So this is going to have a broad area of impact, even if it was just referred to as CPA prep. So as we're going through these, even if you don't know the answers to the questions, I want you to make sure that you think about these in a proper manner and you say, what do I know? If I don't know the specific answer that I'm looking for, what is it that I do know about this topic? And can I use that to answer the questions properly? So this first one is very interesting because we did not talk a lot about generally accepted auditing standards back in 417. That is not because I don't think they're worthwhile, but because they are not necessarily a practical application of auditing work. When I say practical application, what I'm referring to is processes and procedures. Those are generally covered by the auditing standards, which are the PCAOB standards and the ASB standards. Generally accepted auditing standards have to do more with the quality and conduct of the audit. Okay. And I'm guessing that many of you probably had to do a little bit of research for this first question and say, I don't remember GGAS. I don't remember what it refers to. And if you did, you say, okay, these are more just kind of overall guidelines. So there are three sections of the generally accepted auditing standards. There's general reporting and field work. And these, like I said, have to do with how an audit is conducted and what the quality requirements are for the engagement. And some of these things have to do with staffing, have to do with level of supervision, things along those lines. So these are external to the audit procedures and processes that are detailed in the auditing standards. I'm not going to say these are mutually exclusive. Just because something's covered in generally accepted auditing standards doesn't mean they can't be covered by PCAOB or ASB standards, but the focus of those is two different areas. So using that information, now that we have this, let's go ahead and answer this question. So which of the following best describes what is meant by the term generally accepted auditing standards? So this first answer, it sure looks good if we don't think about it. It says rules acknowledged by the accounting profession because of their universal application. But there is one word there that's really problematic. Anybody tell me what that word is? Well, universal is probably a really, really good word. I was looking for accounting, okay? Are we talking specifically about the accounting profession, or are we talking specifically about auditing work? We're talking about auditors. Accounting, and it doesn't even specify what accounting profession we're talking about. We're talking about cost accounting, we're talking about financial accounting, tax accounting. That's a very broad array. So accounting kind of gives away the fact that we can't use this as an application. So A is kind of out. B, pronouncements issued by the Auditing Standards Board. So what did we just say? So pronouncements issued by the Auditing Standards Board have to do with processes and procedures, okay? And so those are going to be the ASB standards that say, okay, how do you do a reperformance of an internal control? How do you actually perform that particular task? And so this is not what we're talking about when we talk about generally accepted auditing standards. By that logic, we can eliminate B and we can also eliminate D because D is exactly the same thing as D. Procedures used to gather evidence for financial statements. That leaves us with C, measures the quality of the auditor's performance, which is something that's measured by generally accepted auditing standards. So even if you were not certain about what you were looking for gas, and you said, I'm going to stay true to the heart of the task, and I'm not going to use an external tool, Dr. Barnes would be proud of me. First of all, if you don't know what the question's talking about, don't feel bad about using an external tool. I think that there's going to be a lot of research required. But secondly, if you were just down and determined, how do we get to C, even if we don't know C is the answer? And the answer is we eliminate all the other answers because of logic. Question number 2 should have been a lot more straightforward. Which of the following terms identifies a requirement for audit evidence? So there are 2 requirements for audit evidence. We need to have evidence that is both sufficient, so the quantity of audit evidence has to be enough, and then it also has to be, so if we're talking about quantity, we're also probably talking about the quality of evidence. What's the term for quality? Appropriate evidence, okay? Sufficient and appropriate evidence, all right? Now, all of these sound like reasonable terms, but this is a specific term that we actually see in the auditing standards. We're looking for sufficient, appropriate audit evidence. So we have enough audit evidence, and the evidence that we're looking at actually signals the truthfulness of the assertion we're trying to test. So sufficient and appropriate audit evidence. Which of the following properly describes the auditor's responsibilities as opposed to management's responsibilities? So it's interesting. I didn't mention this in the first question, but I really don't like the way some of these questions are written. Like, I hate this way the first question is written, because you can't come up with an idea of what it is you're supposed to be looking for just by reading the question. You have to read all the answers. I think this is true also for question number 3, and you're going to hear me complain a lot about the questions. That's just going to be a natural case. Just for context, the Becker questions oftentimes are going to be much more poorly written than the actual AICPA questions. Some of these are because the Becker questions are AICPA questions that were thrown out and were not used. Sometimes it's because Becker just doesn't do a very good job of vetting the questions. I will get very angry at some of the questions later on. I will assign them to you, but I'll still get angry about them, okay? Because they are my irrational hatred for certain topics. But I'm not really angry about this question. I just don't like this. But we do know a little bit about auditors' responsibilities and management's responsibilities. So before you go into this question, let's go ahead and just do a basic outline of what we know about auditors and management responsibilities. So we know that it has to relate to financial statements and internal controls. What's management's responsibility for financial statements? Yeah, preparation and presentation of the financial statements. What's their responsibility for internal controls? Design, implementation, and maintenance of internal controls. Okay, so that's what we're looking for with respect to management, something in that area. What about auditors' responsibility for the financial statements? Yeah, providing reasonable assurance that they're free from material misstatement, effectively testing the financial statements. And then the same thing for internal controls, making sure there's no deficiencies in internal controls, at least not significant deficiencies or material weaknesses. So testing financial statements and internal controls. That's basically it. That's what you need to know in this particular area. Now, the answers are not nearly that simple, but if you use that kind of process of elimination, you can get rid of some of the answers. So let's go through these. The auditor is responsible for the financial statements. Do we need to read any further? Is the auditor responsible for the financial statements? We know, we just established that's management responsibility. So I'm going to ignore the rest of the question or the answer because it's not relevant. The auditor is responsible for identifying the laws and regulations applicable to the entity's activities. Okay, so that's a really hard sell. I don't think that's the case. Okay, but let's keep going. Manager is responsible for affirming the effects of any uncorrected misstatements in the financial statements are immaterial. Okay, no, that's neither one of those are really very close. I would be really hard, even if I thought that there's some sort of argument to either one of these being correct. I'd be really hard to put both of them together. This is a very, very poor answer. And the simple truth is the last statement is patently incorrect. Management can accept an audit with material misstatements. It just usually means that there's going to be an opinion that they don't like. Okay, so that's important to note. Manager is responsible for the entity's financial statements. Okay, we're good. We're starting out strong. Auditor is responsible for the selection of application of accounting principles. Who's responsible for the selection and application of accounting principles? Is it the auditor? It certainly is not. Okay, we do audit stuff, not financial accounting stuff. Okay, so we're not responsible for the selection and application of accounting principles. So we've eliminated A, B, and C. I hope D is correct because otherwise we got a problem. Manager is responsible for affirming the effects of any uncorrected misstatements of financial statements are material. Now, this is an interesting one because this is basically the same answer as what we talked about before. Okay, now that's an important note. I just basically told you it was wrong, and technically, I think that that's a correct statement, but what are we talking about here? If we identify a misstatement, then the management has actually got to affirm that the financial statements are presented fairly, okay? That's something they have to disclose in the financials. So there's an argument for saying that that statement is correct. Now, the reason I don't like this answer is because management does not really know what the level of materiality an auditor assesses in a particular engagement is, okay? So this one's a really, really hard sell. And again, I'm going to kind of argue in the point that I don't think this is correct, but I think that there's enough justification for saying that management does have to make an assessment, even if this is not the precise assessment. So the next part statement is going to say, auditor is responsible for retaining reasonable assurance about whether the financial statements are free from material misstatements. That is a tacitly correct statement. Now, I don't like this answer, but it's the most correct out of all of the answers, okay? I really wish they'd gone with something a little bit more objectively correct, but again, this is when me cautioning you saying, I don't think that these questions are written particularly cleverly or correctly sometimes. But D is going to be the answer that we have. I think this is the only one that has any reasonable justification for being correct. Talking about something that is objectively correct, let's go ahead and look at number 4. Wilson CPA obtained sufficient appropriate audit evidence. So we have the 2 words right there. You probably should have looked back on the question too and say, oh, there's that word appropriate. Okay. To render an opinion on ABCO's December 31st year from 1 financial statements on March 6th, year 2. A subsequent event requiring adjustment to the year 1 financial statements occurred on April 10th, year 2. They decide not to dual date the the report and complete the extended audit procedure subsequent on April 24th, year 2. If an adjustment is made without disclosure of the event, the report ordinarily should be dated what? So let's go ahead and talk about what's being done here. Are we using dual dating this particular event? No, dual dating would imply that we use the original audit report, but we also use a secondary date that refers to the subsequent event. So there's 2 dates. This one specifically says they not dual date the report. So it says not to dual date, so we can't use dual date, not use dual date. That's just logic right there. You can't do something and also not do something. That's kind of that's probably doesn't need to, we probably don't need to work on the CPA exam for you all to know that particular concept. All right, so let's go ahead and figure out what we need to be referring to. So if we're not dual dating, then we're extending the report date. That's basically the definition we're referring to. Now, are we extending the report date to the date of the subsequent event or to the date the testing is completed on the subsequent event? Now, if we were going to go back to 417 and say, I'm not sure, you didn't specifically say it's 417. And I'm saying, you're absolutely right. I don't mention this in 417. But I did mention it in this course. I actually specified this when we were talking about it. I think last Wednesday we talked about it. It is to the date that testing is complete for the subsequent event. So we're going to rewrite the report date or reissue the report date as April 24th, year 2. Okay. Which of the following events that occurred after a client's calendar year ends, but before the audit report date would require disclosure in the notes to the financial statements, but no adjustments to the financial statements? Now, what topic is being referred to by this question? We don't even need to look at the answers to know what are they talking about here? What is the general topic? Okay. Subsequent events. Okay. So subsequent events. In order to answer this question, we need to understand what type of subsequent event are we looking for. Now, remember, there's two types, type 1 and type 2. Type 1 conditions existed at the balance sheet date. Type 2 conditions did not exist at the balance sheet date. What is the treatment for a type 1 event? So like a lawsuit where the lawsuit is still pending, and then during the course of the audit, the lawsuit gets settled. What would be the treatment for that that we'd have to insist upon the client? Fix it in the financial statements. Yeah, make sure that they restate the financials to reflect the effect of the lawsuit being settled. Okay, so this would require an adjustment. So type 1 is not what we're looking for. We're looking for type 2. Now, type 2, there's disclosure at minimum. There's also the possibility that a type 2 subsequent event could require pro forma financial statements. This is for really large impact subsequent events that are going to have a profound effect on the organization's operations. Does anybody remember what pro forma financial statements are? I know it's been a while. For me, it's been like, I just talked about this like last semester. But yeah, pro forma financial statements are forward-looking financial statements that reflect a particular event occurring and how that effect will impact the financials moving forward. Now, that is an extreme situation, but in every single situation, 100% of the situations, a type 2 event will require disclosure. So we're looking for a type 2 event. So new convertible bonds are issued to expand the company's product line. So this one's an interesting one. So new convertible bonds are issued to expand the company's product line. Did this exist at the balance sheet date? No. Okay. So this may be one of those ones. I don't really like this answer, but it does technically meet the criteria that we're looking for. But let's go through the rest and see if we can eliminate those. A loss on reported uncollectible accounts is acknowledged as a distressed customer. So they were distressed as of the balance sheet date, so the conditions did exist. So we can eliminate B. C, a fixed asset is sold at a substantial profit. They're not used in operations, is sold at a substantial profit. The fixed asset did exist before the balance sheet date, so we can say that that was probably a type 1. Negotiations result in compensation adjustments for unit employees retroactive to the fourth quarter. Now, retroactive to the fourth quarter is a clear indicator that the conditions did exist at the balance sheet date. So we can eliminate A, B, and C, or sorry, B, C, and D, and then A is really the only one. Okay. Whether I like it or not is irrelevant. That is the answer. An annual shareholders report includes audited financial statements that contain a report on management operations. The audited financial statements are fairly stated. The auditor is not engaged to report on other information included in the annual report, but the auditor notices there's a material inconsistency between the amount of revenue reported by management and the report on operations, the amount of the revenue reported in the audited financial statements. If management refuses to make the revision of the revenue included in management report on operations, I hate the wording here. The auditor least likely would. Let's just take a question that's already confusing and make it more confusing. So what are we asking here? We're saying, all right, there's a discrepancy between something that we were not required to audit and what we did audit. But that information that we did not audit is using information that we did audit. Do we as auditors have a responsibility to make sure that information is consistent across those reports? Yes, we do. Okay. Remember, we talked about this in 417. This had to do with the shareholders report. Remember that flowers, sunshine, and rainbows report? We don't audit that, but we read it to make sure that they're not misrepresenting what we've done in the financial statements. Okay. So this is saying, if you notice that happens, if there's a material inconsistency between the two, what are you not going to do? What are you not going to do? Well, that means that we have to identify which ones we would do. So would we include in the audit report a separate section with other information describing the inconsistency? Well, we have a section for other information in ASB reports. Okay. So yeah, that probably makes sense. That's a possibility. Okay. So we'll say that is a possibility. Withhold the use of the auditor's report. Well, they're misusing information in the auditor's report. So that probably is one of those ones where say, yeah, you can't use audit report if you're going to abuse it like that. Withdraw from the engagement. Withdraw from the engagement is a pretty extreme scenario, but again, if they're misrepresenting the work that you're doing, then you probably don't want to be associated with that work, so you could withdraw. Modify the opinion of the audited financial statements to a qualified adverse opinion. Now, this one's an interesting one because this one is like saying, well, Dr. Barnes, they're misusing the information. Ask the question this: Did they report anything, or are there? Sorry, I shouldn't say it. Are there material misstatements in the financials? No, we have audited those financials and we've issued an unqualified opinion. Okay, so there's not any problems with the financial statements themselves. It's the use of that information in other reports. This does not affect the financial statements, so we can't issue an opinion saying the financial statements are wrong. That's just tacitly incorrect. So even if we don't like the A, B, C, and answers, and again, this is going to be a common theme throughout the semester, we're not going to like the other answers. We know this one's wrong, so the D has got to be the answer in this particular situation because we absolutely would not do that. Helpful company, a not-for-profit entity. By the way, something that's very interesting to note, and you'll see this when you're doing your Becker work and also when you actually sit for the CPA exam. Did anybody notice how boring the names are? They're just like helpful company. Wow, what an original name, you know? It's not like me going out of my way to actually make fun of my colleagues, all right? The reason they do that, actually, they've said this in a podcast, is that they try to do the most bland names possible so that students and candidates don't get distracted by the names. So yeah, if you're really, really bored taking the CPA exam, that's intentional. All right, that is intentional, just so you know. So prepared financial statements on an accounting basis presented by or prescribed by a regulatory agency solely filing with that agency. Stop. Okay. So they are preparing their financial statements on a specified reporting criteria that is not GAAP. Can they do that? As long as they are a non-issuer company, as long as they are not publicly traded in the United States, yes, that is perfectly fine. Okay. More importantly, can we as auditors perform an audit on specified reporting criteria other than GAAP? Yes, we can. Okay. We just have to make sure we understand the rules of that particular reporting criteria. So agreeing on the financial statements according to generally accepted auditing standards. Now note, this is not saying generally accepted accounting principles. This is the criteria for auditing, not for accounting, okay? They conclude the financial statements are fairly presented on the prescribed basis. Green should issue a what? Well, this is pretty straightforward. As long as we know that they can report on a different criteria other than GAAP, and we can audit on a criteria other than GAAP. We've done the audit, everything's fine. That is going to be an unmodified opinion, okay? A single unmodified opinion on the special purpose financial statement. All right, let's move on to this part. So we did some analytical procedures. What do you guys think about this? There are 9 tabs in the spreadsheet. By the way, okay, I want this noted. If you've ever actually worked through the work in Becker, if you've seen any of the work in Becker, which I know several of you have, okay, transitioning this stuff from online into this format to Becker for the task-based simulations is a nightmare. I spent a lot of time and energy doing this, okay? I want this reflected, okay? I want this reflected that I actually did this to try to make sure that you had an opportunity, because it's so first of all, that presentation format is god-awful, okay? It's so miserable to work with, and considering that I didn't want to mess with the actual presentation online, I wanted to actually have you all be able to work with something that's a little bit more manageable. I said, I'm going to put this in spreadsheets, and this was literally hours of my time spent doing that, okay? So I want you to know, if you respect that and say, wow, this is much easier to read, say, Dr. Barnes, kudos to him. Okay, just give a silent moment of applause to Dr. Barnes. You can hate me for everything else, but for this, I want you to appreciate it. Okay? I'm demanding your respect and appreciation for this. So they're doing an analytical procedure for sales. Now, I'm going to clarify that I think that doing an analytic for sales is not productive, okay? This is not something I would generally do. I've worked through some examples of this. We did one in 417, actually a couple in 417, and we're doing one now. Generally speaking, you can't do an effective sales analytic as a model because there's so many things that affect sales. That being said, we're going to just go with it in that case. So materiality is $40,000 or a 4% change for year-over-year comparison. So we're going to go through, we're going to enter our calculations and our expectations. We're going to evaluate reliability. We're going to evaluate the significance of the difference for each analytical procedure. And yeah, we're going to do for each of these. Now, the first one is pretty intuitive and straightforward, okay? This one's going to be evaluating gross margin percentage and determining if the year 2 is consistent with what we would believe from year 1, okay? So a year-over-year percentage change. Now, this one's pretty easy because we've got the income statement. So even though I just copy and pasted the stuff from Becker, you can go ahead and type this in on your own. So 150, 900, 1411, 500, 875, and 850,000. And gross profit, as we all know, is just sales minus cost of sales. Hopefully, you didn't have to go look that one up, but yeah, that was a pretty easy one. And then we can calculate the percentage just by dividing gross profit by sales. All right. So let me go ahead and change this over to percentage. And I'm going to go ahead and do this 2 decimal places. Now, Here's the interesting part. This is pretty easy, 41.9% and 39.8%. So 39.8%. Now the question is what is the year-over-year percentage change? And I strongly disagree with the Becker answer to this question, okay? My answer to this question is trying to make this simple and straightforward. It is a 2.1% change because math, all right? That's my answer for this question. Becker takes a different position on this one. They say 2.1% is the change in these numbers, but a year-over-year change would also require that you divide that percentage change by what the percentage was, okay? So they say that it's 2.1% divided by 39.8%, which is something like, let me pull up my solution. So that's probably going to be helpful for me. I'm just curious. Okay. Actually, I put my answer as a solution. All right. Okay. So let's just, I guess I can go to the income statement. So I come up here. 2.1 divided, actually, whoops. I don't know why I'm not using a calculator. I'm wasting your time. I'm literally wasting your time, guys. Sorry. My God, my apologies. 1 divided by 39.8. So they say it's a 5.3% change, which again, remember the materiality threshold is going to, or the threshold for reliability or usefulness is going to be that materiality is 4%. So they say 5.2%, and that exceeds the threshold, not 52%, 5.2%. Now, who's right? Probably Becker. You want to check with their answers there, but I think that's needlessly confusing. But that's really beyond the scope of the point, because basically your answer is going to depend on what your answer is here. But what we really need to answer is whether or not this information is reliable. All right. So what do you think? Is the information reliable enough that we can use in the analytical procedures to test it? I would say yes for a couple of reasons. First of all, it's information that we would normally use for an analytical procedure, which would be client's financial statement data. Moreover, one of these bases has already been audited in a previous period, so we know the accuracy is high, okay? So I would say that this is going to be highly reliable. Evaluate significance of the difference. If you take Becker's, they're going to say, well, the difference is material, further investigation is, or sorry, not differences in material, difference in material, further investigation is necessary. Now, if you came up with me and you said 2.1%, which again, I would not give you something so vague on this one and say this, 2.1% would not be the opposite. This would be differences in material, no further investigation is necessary. Again, what is the argument? Is the argument correct? I will fight to the death on this one, but I do think that was needlessly confusing. Fortunately, we don't have that problem with the other ones. So we have a square footage of external industry data. So we had to go and look at some information, and so the National Fitness Association says the revenue per square foot is $105.60, and if you look at their disaggregated sales information, they say 14,550 square feet. So that's pretty easy. 14,550 and times is 105.60. So $1,536,480. I can't believe I remembered that. I forget everything. Get out of the way. This is obnoxious. There we go. Like I said, just let's sit off the top. All right. So part two. So expectation is 1,536,480, and sales actual is 1,506,900. So the dollar difference is $29,580. So significance of the difference. This is obviously not material because by the instructions it says it has to be $40,000 or less. So we can go ahead and say difference is immaterial, no further investigation necessary. Now, this is assuming that this data is reliable, and I've already kind of given you the answer to this because I put this as the input. Is this reliable data? Okay. So it's external data. What is the likelihood that our client can manipulate that data to their own ends? That they can manipulate external industry data? Probably not a whole lot. And they don't have a reason to misreport their square footage data either. That's something that from a financial perspective doesn't make any sense. So I think both of those data points make a lot of sense. So we can say that this is reliable data. Part three, expectation based on sales commission. So basically, you can kind of do the math because they have the internal memo and they say increasing commission percentage from 4% to 5% for all sales. So we can use that as our basis for calculating the sales commission. So again, Year sales actual is exactly the same as what we said in the previous tab. And then you should have calculated expectation for sales is $1,578,000, which is just basically the commission divided by 5%. So a dollar difference of 71,100, which is a material difference. But let's back up real quick. Let's talk about the reliability of the data. Did anybody say that this was not reliable data? Okay, so I had a few people that says not reliable data. Take that hand that you raised and give yourself a nice pat on the back, okay? Because it was not reliable data. Why? Let's think about what the nature of sales commission is, okay? Do sales commissions originate from sales, or does sales originate from sales commissions? The other way, it's the wrong direction. We're moving the wrong direction. We can't really use sales commissions to determine what sales should be, because sales commissions are a function of sales. All right. It's a little bit the way I described it last year, and I think this is a pretty good logic to say. It's a little bit like a circular reference in Excel. You calculate one thing, and then you try to use that other thing to calculate the original item. It's going to say, oh, I hate this. I hate this. You can't do this. Excel will get really angry at you. So the direction is wrong. So the evaluate the significances, we can say it's not reliable data because we're using something that's a function of sales to try to predict sales. So evaluate the significance of the data, the difference, we're going to say the method's unreliable, perform alternative procedures. That's where that comes up right there. Okay. We've got about 7 minutes left. So here's what I'd like for you to do. I'd like you to close your laptops. And to the best of your ability, answer these two questions. There's only two of them, but provide me with a little bit of an explanation for what your answers are. We don't have a lot of time, so I'm going to go ahead and let you do this with the short amount of time we have left, but please make sure you provide sufficient response. I don't know is not an acceptable response. That will give you 0 points for the assignment. Did I knock that over?
All right.
Problem me, big and
That's okay.
I apologize for not giving you much time to work on this. I will try to do a better job in the future, but I do want to give it at least a couple minutes to debrief on these real quick. Feel free to take notes if you want, if you need to add any information when we're going through this. So number one is the most difficult of the two questions by a long margin. It's a responsibility of auditors to include all the following except which one. The way I would recommend approaching this question is look at the answers and determine which ones are absolutely ironclad responsibilities. We need to eliminate them down. Even if one answer looks like it might be, if you know that 3 of them absolutely are, you can eliminate the other. So appropriate competence capabilities to perform the audit. Yeah, you do need to be able to perform an audit to audit. Okay. Complying with relevant ethical requirements. That is dictated by the Code of Professional Conduct. You do have to meet the requirements of the profession. Maintaining professional skepticism and exercising professional judgments about planning and performance of the audit. Yes, that is absolutely required as well. Those are 2 benchmarks of the profession. So then we have B is left. Minimum amount of technical knowledge and experience in the industry which the client operates. That would be really good to have, and I would say that you probably want to have that at some point during the audit. But if you walk into an audit with no knowledge of the industry, that does not disqualify you from doing the work, okay? That does not disqualify you from doing the work. It just means that you're going to have to gain experience or knowledge in the industry. You may have to call in special expertise in that area to actually supplement the work. So B is our answer, even though it looks like it could be a requirement in the situation. 2 was a little bit more straightforward, okay? So we've already dealt with a question on dual dating. In that question, we said that it was extending liability, not dual dating. This one's saying we are dual dating. What does dual dating do? It limits liability. Specifically, it limits it to the specific event reference, okay? So limiting to the specific event reference. All right. Please make sure that you give me your notes so I can take a look at what you're doing in here. I'm not going to critique them too heavily these first few times around, but I would like to see what you're doing in your answers. Have a good weekend.